To talk markets as we get close to the opening bell, Sarat Sethi, managing partner at DCLA and a CNBC contributor. So we got CPI now and PPI. We had retail sales kind of weak. I'm not ready to say stagflation necessarily like Rick, but it certainly has the feelings more than last week that might be something that we're looking at, Sarat. Maybe a little bit of a slower economy. But persistent inflation, which is like the worst of both worlds.
I mean, if that is the case, yes. I mean, we're definitely in for higher for longer for interest rates. And I think on the economy side, it'll be interesting to see, because if things do slow down, what will be price takers, and will companies be able to keep on raising prices, and will wage increases still happen? So I think there's going to be a little bit of a lag effect on that as well. But in terms of the stock market, I think it'll make things very interesting, because what you really want to do is say, look at, well, what are the alternatives for investors? So higher yields means interest rates are higher, we can buy more bonds. So there's an alternative. Secular growth stories are going to be really important. So I think that's where some of the capital is going to flow. So I do think there will be opportunities, especially if rates stay at this level for a while longer.
Because for a while, when we were, Fed was mission accomplished, victory lap, everything else, it was like, wow, look at the GDP and look at the labor market every first Friday of every month. It's so good. And inflation's coming down. It looks like we have the best of both worlds. Inflation's coming down, the economy's staying strong. All we need is a week, and suddenly we're back to the flip side, which is, one is like Goldilocks, the other is stagflation. And it doesn't mean you need to change everything, but it feels a little bit different than it did when we were hitting all new highs. And we, that was a good place to be, a strong economy and falling inflation. Are we there still?
Yeah, well, that was soft landing, right? That was the exact scenario for soft landing. Now we're in either no landing or hard landing, and the market needs to factor that in. So I do think, again, we need to wait for more data if things are slowing down. It doesn't mean they're coming to a halt, Joe. It just means that, hey, the growth that we had that had so much juice into it because of what we had done with interest rates before is now catching up. So I do think, and look, the Fed has the lever. So if inflation at some point comes down and demand stops increasing, and that was the whole idea, right? We wanted supply up, which is what's happened. And if demand slows down, you could see that inflation. But 2% is going to be a tough number, Joe. I think that's given what's happened during COVID.
Well, we might be going up now. We might not just be going to too slow, or we might be going up. Now we heard about mortgage rates. So you could see, some tough, tough factors for the economy combined with persistently high inflation. And that's not good.
All right. So just to recap, Sarat Sethi said interest rates will definitely be higher for longer, guys. This week we had CPI, PPI, and retail sales all come in hotter than expected, which is a weakening economy. We've got a slowing economy with sticky inflation. That is a horrible combo, guys. We've got the 10-year back above 4.3%. We've got stocks on a 5-week winning streak. That's extended, guys. And with all this bad news, that's not a place you really want to be. January's PPI came in 0.3% versus 0.1%. So again, hotter than expected. Sarat says we're either having a hard landing or no landing. Those are the only two options. He says interest rates are catching up, and he says when bond yields go up, that competes with the stock market appreciation. So money flows out of the stock market for risk-free returns in the bonds. 2% is going to be tough to get to as an inflation rate for the Fed, guys. Other than that, I hope you enjoyed the video, and I'll catch you in the next one.